Stocks are safe for the long run, and they're very unsafe for tomorrow. Berkshire, 3 times since I took over, has gone down roughly 50%. Did I feel poor then? No, not at all. I knew it was going to be worth more over time. American business is going to be worth more over time. That's what you're buying as a business. You're not buying a stock. You're buying a piece of a whole bunch of businesses.
Welcome to our exploration of the wisdom of Warren Buffett, one of the most successful investors in history. In this video, we'll dive into Warren Buffett's list of top common investment mistakes to avoid. We'll simplify these lessons and make them engaging to help you navigate the world of investing. Number 1. Excessive cash hoarding. Warren Buffett's investment philosophy offers a balanced approach when it comes to managing cash. He advocates for the importance of making money work for you by investing it in profitable businesses, highlighting the need to avoid hoarding excessive cash. However, he equally stresses the significance of patience and discernment, cautioning against rash investments just to alleviate the burden of holding excess cash. In Buffett's view, wise investing requires a strategic and thoughtful approach that balances the efficient use of funds with the avoidance of impulsive decisions, emphasizing the importance of waiting for the right opportunity to ensure successful, long-term wealth creation. Number 2. Market timing. Warren Buffett, along with his trusted partner Charlie Munger, shares a fundamental belief that attempting to forecast short-term market gyrations is an unproductive endeavor. Instead, they champion a strategy that centers on understanding the enduring strengths and attributes of the businesses you plan to invest in. Their philosophy underscores the futility of trying to time the market, emphasizing that true success in investing comes from taking a long-term perspective. By concentrating on the underlying fundamentals of the companies rather than being swayed by daily market fluctuations, they encourage investors to transcend the noise and commotion of the moment, focusing on the business's intrinsic value and their potential to deliver sustainable returns over time. This perspective aligns with their patient and prudent approach, emphasizing that real wealth is built through a profound understanding of businesses and a commitment to holding investments for the long haul. Number 3. Diversification. Warren Buffett's perspective on diversification brings a refreshing simplicity to a widely debated concept in the investment world. He cautions against over-diversification, emphasizing that holding an excessive number of stocks can be counterproductive. His reasoning is straightforward. Diversification serves as a safeguard against ignorance, intended to protect investors from being overly exposed to any single investment's risk. However, for Buffett, the key lies to understanding the businesses in your portfolio thoroughly. If you have a deep comprehension of the companies you hold, the need for an extensive list of holdings diminishes, making the principle of staying within your circle of competence the cornerstone of his approach. This philosophy advocates that investors should focus on what they know best, enabling them to make informed and astute investment decisions, rather than diluting their expertise across a vast array of assets that they may not fully understand. Number 4. Not investing within your circle of competence. Warren Buffett's emphasis on staying within one's circle of competence forms a fundamental pillar of his investment philosophy, underscoring the need for investors to focus their resources on areas they genuinely understand. This principle is a strategic guide that directs individuals to invest in industries and companies that they can thoroughly grasp. By doing so, it mitigates the inherent risk of making uninformed investment decisions, stemming from a lack of knowledge and comprehension. Buffett's philosophy essentially encourages investors to play to their strengths, aligning their investments with their areas of expertise and knowledge. This not only helps in making well-informed decisions, but also fortifies an investor's confidence, allowing them to stay resilient amid market fluctuations and ultimately contributes to building a successful long-term investment portfolio. Number 5. Not being patient. Patience, as endorsed by Warren Buffett, embodies a key differentiator that distinguishes seasoned investors from impulsive speculators. His philosophy underscores the significance of maintaining a long-term perspective in investment endeavors, rooted in the understanding that wealth creation often unfolds gradually over time. Buffett firmly discourages reacting to short-term market fluctuations and the noise of daily trading. Instead, he advocates the wisdom of focusing on the enduring fundamentals and prospects of the companies in your portfolio. This strategic patience serves as a shield against emotional decisions driven by market volatility and engenders a steadfast approach that seeks to capitalize on the intrinsic value of investments. Number 6. Not keeping emotional discipline. Warren Buffett's investment wisdom rests significantly on the bedrock of emotional discipline, and it stands as a defining element of his approach. He underscores the need to distance oneself from the potent emotional forces of fear and greed, which often lead to irrational and costly decisions in the investing world. By emphasizing the importance of maintaining a level head and rational mindset, Buffett seeks to insulate investors from the psychological traps that can accompany market turbulence and the allure of quick gains. This discipline is not merely a suggestion, but a crucial requirement for those who aim to navigate the unpredictable seas of investment with a steady and informed strategy. Practicing emotional restraint aligns with the long-term perspective Buffett advocates, promoting a consistent and measured approach that seeks to build wealth with a prudent and rational mindset, rather than being swayed by the emotional currents of the market. Number 7. Not doing thorough research. Warren Buffett's commitment to thorough research is at the core of his investment strategy, emphasizing the necessity of conducting comprehensive due diligence before committing capital. He goes beyond the surface, delving into the company's financial health, evaluating the competence and integrity of its management team, and scrutinizing the competitive advantages it holds. This meticulous research is far from optional. It is an unwavering prerequisite in Buffett's world of investing. Seasoned investors like him recognize that these foundational investigations serve as a protective shield against impulsive and uninformed decisions, setting the stage for well-informed, calculated investment choices. In essence, the practice of exhaustive research is a safeguard that allows investors to build a portfolio based on a deep understanding of the companies involved. Number 8. Seek sustainable competitive advantages. Warren Buffett's pursuit of companies with sustainable competitive advantages, or what he terms as economic moats, lies at the heart of his investment philosophy. These moats represent a protective barrier that encircles the company's profitability and market position, guarding them from relentless competition. For Buffett, identifying businesses with these enduring advantages is not merely a preference, it's a strategic necessity. Such businesses tend to have the resilience to weather economic storms and maintain their profitability over the long term, aligning perfectly with his emphasis on a patient and enduring approach to investing. Number 9. Quality management. Warren Buffett's reverence for the quality of a company's management team is a defining feature of his investment approach. He places immense importance on investing in businesses that are led by trustworthy, capable, and reliable leaders. These leaders are considered good stewards, consistently making decisions that serve the best interests of the company and its shareholders. For Buffett, it's not merely about the numbers or the financial health of a company. The people at the helm are pivotal. He recognizes that a management team's competence, integrity, and strategic vision directly impact the long-term success and profitability of an investment. In essence, Buffett's emphasis on exceptional leadership underscores the vital role that management plays in the stewardship of shareholder capital, making it a non-negotiable criterion in his meticulous selection of investments. Number 10. Quality over quantity. Warren Buffett's investment philosophy champions a fundamental principle of quality over quantity. He advises investors to eschew the temptation of owning a multitude of stocks and instead focus on a few select wonderful businesses. In his view, having a deep understanding of a handful of companies is far more valuable than holding a vast array of stocks with only surface-level knowledge. This approach is not about diversification through quantity. It's about concentrating on a small number of investments that an individual can truly comprehend and monitor closely. For Buffett, the essence lies in the depth of knowledge about the businesses one owns, which enables more informed and strategic decisions. This perspective reinforces the concept that a well-considered, focused approach often outperforms a scattered one, ultimately resulting in a more robust and successful investment portfolio. Thanks for joining us on this journey through the insights of Warren Buffett. If you found this video informative, don't forget to hit the like button and subscribe to our channel. Feel free to share your thoughts in the comments section below.